Good morning, everyone, and welcome to today's webinar presentation, How CFOs Can Prepare Their Owners for a Successful Exit. This is presented by the Twin Cities chapter of FEI, and we do welcome you this morning for our presentation. Before we begin, I would like to review a few housekeeping notes. Today's presentation is worth 1 CPE credit. To be eligible for that credit, you must answer at least 3 of the 4 polling questions during the webinar and have a total viewing time of 50 minutes. CPE credits will be available in 7 to 10 business days after the webinar. We are unable to grant CPE credit in cases where technical difficulties preclude eligibility. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements as stated. And in accordance with the standards of the National Registry of CPE Sponsors, CPE credit will be granted based on a 50-minute hour. And now it is my privilege to welcome Jill Nussbaum. Jill is the Professional Development Chair for Twin Cities Chapter and is also the Engagement Director at Cliff Larson Allen. Welcome, Jill.
Thank you, Nancy. On behalf of FEI, I'd like to welcome all of our members, strategic partners, and guests who are joining us today. We're delighted that our strategic partner, BMO Harris, is joining us to discuss how CFOs can prep their owners for successful exit or sale. Before we kick off today's program, I'd like to make you aware of just a couple of upcoming virtual programming events. Join us on February 18th when Be the Match, Amy Roneberg, and Senior Vice President Julie Smolik discuss how they navigated uncertain and challenging times to reach a milestone of impacting the most lives ever through their support of blood stem cell transplantation. And then join us also on February 23rd when our strategic partner CIBC discusses the trajectory of the economy, the implications of the US elections, and the longer-term implications of the economic crisis. You can register for these events and more at feitwincities.com. And now I have the pleasure of introducing Jennifer Johnson, Vice President in the Corporate Advisory Practice at BMO Harris Bank. Jennifer will introduce our panelists and moderate today's session. Jennifer?
Perfect. Thanks, Jill, and good morning, everyone. Thanks for your participation. As Jill mentioned, I am a Vice President in BMO Harris's Corporate Advisory Practice. We spend the majority of our time working with privately held middle market companies around anything ownership transition, buy-side advisory. So the topic at hand today is near and dear to our heart, something that we spend a lot of our time on today. We've gathered a diverse panel to help make sure that when you walk away from the presentation, you can really be comfortable both from how do you prepare for a transition, what does it feel like during the transition, and maybe what are the things that you should be aware of afterwards. There's a lot of emotion that goes into it, and so as many tips that we're able to provide, that's our goal. So before we start into our conversation, I want to have each of the panelists share a bit more about their background and their experience with preparing for sale. So with that, I'm going to transition it over to Malia Haskins to get us started.
Thank you, Jennifer. It's great to be with all of you today. As Jennifer said, my name is Malia Haskins, and I'm currently a private wealth advisor with BMO Private Bank in Minneapolis. My original career path was practicing law, but for the past 24 years, I've been in financial services, specifically working with high net worth and ultra high net worth business owners focusing on the personal side of exit planning. Whether the business stays in the family or whether it's sold to a third party, having a personal financial and legacy plan is critical to ensure a successful transition for owners, and in many instances, to further the continued viability of the business. I'm really excited to be part of the esteemed panel today, and I look forward to the discussion. And with that, I'll turn it over to Matt.
Thanks, Malia. I'm Matt Markison. I'm a vice president on the BMO Middle Market Mergers and Acquisitions team. I've been with BMO for about 5.5 years, providing a variety of advisory and execution services to companies ranging anywhere from 50 million of enterprise value to 500 million or higher in enterprise value over a wide variety of industries. Today, I spend most of my time helping families and founder-led businesses recapitalize or sell their business. I also spend quite a bit of time advising mid to large cap companies divesting non-core assets. And today I have the pleasure of speaking with one of my former clients, Jim Glonset. So Jim, you're on mute.
Hi, sorry about that. Hi, my name is Jim Glonset. I'm the CEO of Sportech LLC. We are a platform company held by Monomoy Capital Partners. We are a product development company in the power sports industry. We sell into real cool, iconic brands such as Polaris, John Deere, Arctic Cat, and BRP. I'm in my 10th year with Sportech, holding roles of increasing responsibility, including director of sales, general manager, COO, and recently, after the sale to Monomoy Capital Partners in November of last year, became CEO. I'm a Maple Grove guy with a wife and 2 teenagers and 2 dogs, and business is good. However, I'm not having as much luck ice fishing this year as I was hoping to, but pleasure to be here.
Perfect. Well, thanks everyone for taking the time quickly to introduce yourselves. We'll go ahead and get started with some of the questions. So wanted to focus first and foremost on what happens ahead of a sale. And when I say ahead of a sale, I really mean years in advance of a sale, the preparations that should be going on. So really want Matt and Malia to start with who are the key people that, you as the C-suite should be getting to know and having your ownership team get to know, so that when the time does get near where you say, hey, the sale's going to occur this year, it's going to occur in 6 months, you've got the right trusted advisors at the table that you've built relationships with over the last couple of years, so you can move forward and be comfortable that you've got the right team beside you. So Matt, I'll maybe have you start with the business side of it, and then Malia, if you could talk through the personal side.
Sure. And what I guess I'll say is, probably going to occur a little bit closer to a sale. And Malia might talk about something that might happen well in advance of a sale. But at the very least, a family or a founder should have a good attorney. First and foremost, there are a lot of legal documents that need to be negotiated as part of the transaction. A good accountant or group of accountants, army of accountants, both on the assurance side and the tax side, both are incredibly important. And then a good investment banker to help shepherd the process through, as it is an intense process. And generally speaking, these events are pretty seminal and you only get to do them once. So having that handful of good advisors will really make life a lot easier, especially given the fact that selling your business tends to be a pretty emotional and hectic time. But Malia, maybe you can talk a little bit more about kind of prepping in advance of the sort of 6 to 1 month or 6 month to 1 year window prior to a sale.
Sure. Thanks, Matt. Yeah, ideally, maybe 3 to 5 years out from any anticipated sale, having, you mentioned kind of a business attorney, but I think having an estate planning attorney. Sometimes they're the same, oftentimes they are not. But an estate planning attorney who can really focus on the legacy plan. There are various strategies that can be incorporated into an estate plan that can accomplish capturing value for the business, the appreciation on the upside for the business, and shifting that to family members. And that can be done for generations if that's an objective. Similarly, I think a CPA on the personal side, having a CPA that works through the business, oftentimes they're interrelated and they may be the same CPA, but they may not. So I think just to make sure that that personal side is being addressed is important. Having probably not 3 to 5 years out, but maybe as get closer to sale, a business appraiser or a business valuation expert to be able to establish more clearly what the value of the business is for purposes of the sale. I think there are two different valuations. You know, when you're doing planning, you can rely on a lesser, less robust appraisal. But as you get closer to sale, of course, I think all parties involved will want there to be a pretty specific and detailed formal appraisal that's done. I think one area too that's often overlooked for a business owner is kind of the psychology of exiting the business. So I think the sooner that a business owner starts to work through the process of letting the business go, whether that is in conjunction with some sort of a counselor, maybe that's not necessarily needed. Maybe the business advisor or the CFO can play that role oftentimes, but it's very difficult for owners, especially as they're working toward that exit. Many business owners have real difficulty letting go. That they can articulate that that's what they want to do. They can, put a plan in place for that to happen. But in actuality, separating from the business is oftentimes extremely difficult. So acknowledging that and addressing that with some resources, I think is very advisable. I think also an insurance professional. So oftentimes insurance is part of, a business structure. And so just having somebody that can interpret the insurance and understand the implications of either, transferring insurance or, having it, restructured within the business itself is critical. So those would be some of the, other professionals I think it would be important for a business owner to work with. And from my perspective, the sooner, those relationships are formed, the easier the transition will be, and the greater likelihood that the owner will be in a position to fully capture more value and more appreciation and put it into potentially structures or create a plan that will truly capture the more significant value and get that to family, again, if that's a goal. So
Thanks,
Jen, maybe I'll turn it back to you.
Yeah, thanks, Malia. And I think that background is helpful. I think we see in a lot of outcomes that so often we're maybe only focused on the corporate side of things and not the personal side of things. And what we find is that when the C-suite and owners really take the two in conjunction, they find that the business ends up with a much more satisfying outcome because they're coming into the process informed. They understand what different structures mean for them both on day one, as well as what it means for the rest of their life post-sale from a wealth planning standpoint. I'm starting to see a few questions that are coming in through the queue that are about quality of earnings and working capital schedules. And I think it pairs well with the question that I have for Jim. The success of sales is a lot of times really driven by what the business has been doing in the years ahead of a sale. So Jim, would be helpful to hear from your perspective, having gone through the sale, what internal business investments that you and ownership prioritize that really made your sale a whole lot easier of a process than it may have been absent those investments in people, reporting, et cetera. Because I think they all, line up with some of the things that Matt's going to ask for when he gets engaged.
Sure. Well, good question. Yeah, I think when we looked at the business holistically, you got to have a story to tell for sure. A story around business infrastructure, a growth approach, a proven, capable management team. So we were, we were always trying to look for gaps in those areas to have a well-rounded organization. And business infrastructure, that was just beyond brick and mortar. You're really looking to portray kind of confidence in your reason for being or your value proposition to the world, and then a way to translate that into actionable daily processes. So really focus on a consistent sales strategy, consistent customer support. How do we repeatedly produce our goods and services, a strategy and a process around the delivery of that. And then, capacity is always an interesting one as you're trying to navigate growth. And as you look at something that would be attractive to a buyer someday, you don't want to be at a point where you're tapped out on human capacity or physical plant capacity in the case of a company like ours from a manufacturing company. So those were a lot of areas where we were looking for gaps. Business strategy is important too. I think understanding how you lean into the market and what defines your differentiators are important. What is your shared vision for the organization? Do you have a 1-year plan, a 3-year plan, a 5-year plan, and can you express them? That seems, one, I think it's a great way to run a business, and we run Sportech on the EOS traction strategy. But to have an aligned organization that can consistently tell that story, I think was important to how we were prepping the organization. Most company sales are fueled by our value creation, whether it be an equity buyer, whether it be a strategic buyer. So you're talking EBITDA expansion and improving free cash flow. Are you growing is important, and making investments in, one, the ability to grow, and two, the people and processes to grow, I think is going to be critical as you share a compelling vision that growth can continue after the sale under new ownership. And then we spent quite a bit of time at Sportech looking at a proven, capable management team, and that next layer of management under that to really fuel the business strategies. Both a strategic buyer and an equity buyer will prefer, in my opinion, to have a seasoned and aligned team to run the business post-transaction. The more turnkey the team, the more the business is worth. And we made additional investments in the finance part of our business. The rigor of the transaction is significant on the finance group for sure, and that's a pretty important ongoing area that certainly, as we were sold to a private equity company, becomes a lot of the interaction between the platform company and the organization. So we made strong investments there. From personal standpoint, experience, these transactions, they can cause significant anxiety and excitement, hopefully, with the leadership team. I believe that your chances for a successful transaction are to get resources between leadership team and ownership aligned, and make sure everybody's properly incentivized, and a good transparency of what's going on with the overall goals of ownership. So.
Thanks for that. And building on that, I think a lot of times we sometimes see that CFOs may come up with hesitation from their ownership team of making the investment into additional management or enhancing the rigor of the financial reporting that they're doing, or becoming more disciplined with their working capital. So Matt, it would be really helpful if you can kind of give a few tips and pointers of why it makes sense to make those investments in the future, for how it can transform the outcome for the company when the sale actually does occur.
Yeah, I mean, it really enhances the overall entity, and it eliminates some of the question marks around the sale. I mean, if you don't have your affairs in order, you could be surprised by a number of things when you get into due diligence with a potential buyer. Same to be said about your management team. I mean, if you don't have a group of strong players surrounding you, you never know really how a buyer's going to interpret that. Maybe they don't care, but chances are they probably do. So, better to invest ahead of time and find some confidence with that team prior to finding out mid-process that they're not the right team. You might leave a lot of value on the table. Going back to address the Q of E and working capital questions, I'd say in 95% of the transactions we do, we have a sell side quality of earnings prepared as we're preparing our marketing materials. Sometimes it's the existing, audit firm, or sometimes it's a third party. Both are typically fine. Generally within an audit firm or within a CPA firm, they're two separate and distinct teams. So buyers don't really look into it as an issue. Oftentimes it's better to have, somebody that can get up to speed quickly, or, knows the financials of the business. So, whatever the preference is, but it's important to have an understanding, especially in the family and founder-led context. I mean, in certain circumstances, the company's really used as their personal piggy bank. And you really want to strip all of that out post-transaction, because that's just not going to flow through the P&L or, sit on the balance sheet, once a change in controls happen. So, and that can, be meaningful from a valuation perspective, finding those add backs, and figuring out which assets stay with the business and which, stay with the seller. So it's very important. So the quality of earnings process starts sort of once marketing, or once pre-marketing kicks off, once you're preparing a confidential information presentation. So you can engage, right after you engage an investment banker, we come prepared with a list of referrals or recommendations in every process. And we've worked with a number of folks on the QB side. From a working capital perspective, that kind of falls out of the QB and is sort of an ever evolving, target as you kind of march through marketing and as the company performs while you're marketing the business. So the two are hand in hand, and the quality of earnings firm should be addressing that, as they're doing their work. So, outside of that, I think Jim nailed it. I mean, clearly he's gone through a sell side process before, and there are certain things you just don't know out of the chute if you're doing it for the first time, and so Jim and his team are they're a good team, and they really wanted to know what they could be doing better through the process, or what they were doing well. But I'd say, Jim, it'd probably be true that if you went through a sell side process again, it might look a little bit different from a preparation perspective on your end, knowing what you know now versus doing it for the first time.
Yeah, for sure. I mentioned the anxiety and kind of the excitement through the process, the interaction between the potential buyers and the potential acquired company it's an interesting courtship / conversation, challenging your business, kind of calling your baby ugly from time to time. I think we're kind of a competitive team. I think that we would get a little defensive sometimes through the process, and really you're just trying to marry up a company that is trying to understand where there's opportunities to grow a business and where an acquirer could be adding value to the company. So we probably would have done things a little bit differently there. And we certainly learned a lot about the value drivers of at least what private equity is looking for. We didn't pay a lot of attention to free cash flow, and that wasn't something that the leadership team focused on a lot, which is super important to an equity buyer. So there were some other areas of the business that from just kind of the technical way the business operates that we probably could have been better versed. but you guys did a great job at BMO of navigating us through that for sure. And you know, kind of explaining why that was important to the buyer and we couldn't see it. So
that's helpful. So Malia, kind of building on a little bit of the lessons learned that Jim briefly touched on, and we'll get into later in the presentation. We talked a little bit about the advisors that you should be getting to know, but can you maybe touch on why, you know, timing with the personal side of things can be extremely important, and how, you know, waiting too long may limit the flexibility and the strategies that your ownership team may be able to pursue, just given that certain structures require longer setup than others do?
Yeah, absolutely. Yeah. Many of the strategies that are available to capture appreciation relative to equity, or the business owner's equity, really need to be implemented when the value of the business is lesser, obviously, before the value has peaked, right? So getting that ownership structure, or the ownership structure in sync with the estate plan is critical. So there are various trusts that can be set up that equity should be shifted over into. And the sooner that's done, then the greater the likelihood that upside will be protected for long-term from generation skipping, estate tax, and gift tax. So it's just critical that those discussions start happening very well in advance of any potential sale. And I think that needs to also be done in conjunction with an overall financial plan, because an owner, what is an owner? It's really difficult to give up control and cash flow, right? And so if you're shifting shares of stock or equity into a structure that's irrevocable, meaning it's a trust that you can't change the terms of, and to get the benefits from a tax perspective, you can't have any real control over, and ideally don't take a lot of the income from. When doing that, then that's sometimes a hard sell. If you don't have a financial plan in place that can actually help an owner visualize what doing a strategy like that would have from on their personal personal side of things. So and there are certain structures, charitable trust. I'm thinking in particular of a charitable remainder trust, which is a way to shift assets that have already appreciated into the trust, avoid on the personal side having to recognize those cap gains. The grantor of the trust, technically, usually the business owner, would then get an income stream back from that trust. And then when the trust terminates, whatever's remaining goes to charity. But if that structure is created too close to the sale transaction, where the trustee of the charitable trust, in essence, wouldn't have any ability to do something different with the equity that was placed into the trust. So if, for instance, an actual sale contract has been signed, then that is likely to be challenged by the IRS as a transaction that was really done for purpose of tax avoidance and not for a charitable purpose. And so having a strategy around, incorporating that kind of a structure into the plan is something that should be done, well in advance. And just as a little aside, right now, we're in an environment where on the estate tax, on the federal estate tax side, the exemption amount is very robust. It's as robust as it's been since I've been in financial services. And so it's at roughly 11.5 million per person that you can transfer that wealth during lifetime or at death. So many business owners transfer some of their equity into structures and capture that 11.5 million, but that 11.5 million is likely to be reduced. If nothing's done by Congress, that exemption amount lapses in 2026. But with the change in the administration and the compilation of Congress, it's likely that we're going to see some tax changes. And there's been, a proposal that the exemption amount be significantly reduced to, 3.5 or 5 million, as well as the potential loss in step-up basis. And so, having a CFO that is in tune with those changes and then can help the owner stay up to date on their planning is certainly a value add. But oftentimes, it seems like we as advisors are sitting in the chair and you get the phone call from a client who says, just sold my business, which is great. That's a wonderful phone call to get. But there's still plenty of planning that can be done. But I think to really maximize the full value and to, put, say, at currently 11.5, or if it's both a husband and wife and they're leveraging that exemption, you're putting $23 million into a structure potentially if you go all in, and any future appreciation on that 23 million is going to pass to the beneficiaries of the structure. Children, grandchildren, and it'll be free of estate and gift tax, which is a pretty compelling thing to do, especially when you can craft that structure in a way where the owner still can have control of the business and still has some opportunity to receive an income stream from the structure. So if an owner is interested in kind of maximizing those things, then the planning well in advance and not only implementing the plan, but then continuing to maintain it is critical.
Perfect and well said. So want to transition a little bit. I think we've focused a lot on what you can be doing ahead of the transaction, but want to get a bit more into what's happening during the process and want to touch on both structuring. I see a couple questions on what typical reps and warrants policies look like, as well as how common are multi-year earnouts. So we'll have Matt touch on those. But before we do, I think preparation is just about as much about knowing what to expect once you are there. And so, Jim, can you elaborate a little bit more on what you were feeling while the process was actually going on, what it seemed like your owner was feeling, just so that folks can kind of prepare for some of that?
Jim, before you start, could I just let the audience know we have our second poll up on the screen? I'll give you just a few seconds to answer that, and then I'll share those results so that the folks on the panel can understand what your interests are. I'll give you just a few more seconds, folks. All right, I'm going to share those results. And there you have it. Thank you.
All right, perfect. And to the extent that anyone has more questions about preparation pre-sale that we haven't addressed, please do make sure to put in the Q&A box. We will address them as we can as we move through the presentation. But Jim, I'll let you go ahead on how everything felt.
Yeah, certainly. And we felt a lot. It's certainly an emotional and taxing experience for our team, both ownership and management. It was a new experience. Nobody on my team or the owner had ever been through it. So from the initial meetings to start to develop the management presentation, through the opening meetings with potential buyers, through due diligence, we said it before, we really relied on the team at BMO to navigate us through the process and help us understand, one, how to properly prepare, and two, why we were going through the steps. The terminology is new, the acronyms are new. Feels like you're doing from a fire hose through the entire process. And well, we did get some nice dinners through the process, which was kind of fun. And you get to meet some really smart people. I think even we were sick of seafood towers at the end of the getting to know the potential buyers. Culturally, internally, the confidentiality of the process is very interesting. It becomes a bit of a juggling act with all of the folks in the company and people that are kind of in the know of what ownership is trying to do and in partnership with leadership. It becomes a lot of closed door meetings, big chunks of time blocked out on people's calendars, people starting to ask questions. You got a lot of folks coming through doing tours. So there's something that you have to think about and manage through the process there as far as how that felt. In addition to that duality, you have a business to run. You have results that you are delivering that are pretty germane to the transaction at hand. So you're motivated to keep the day-to-day of the business running very, very well when you're in a pretty taxing and distracted environment. You certainly spend more time talking about the trailing 12 months than you ever did in the normal running of the business. With regard to ownership and the leadership team, one dynamic that developed during our transaction was a bit of a separation from the owner. It was far from intentional, but the leadership team and myself, we were spending a significant amount of time through both management presentations and due diligence supporting the sales process and showing that the business could run without him. And meanwhile, he's managing all of the sale negotiations and things on his end of the business. And so that it wasn't an intentional split, but certainly you had a couple of people that were really, really busy trying to deliver on their responsibilities through the dynamic. And that can be pretty challenging. So you really hope you have a high amount of trust and a high amount of alignment between all parties when you're entering into something like this.
One thing that we often spend a lot of time on is getting an understanding of management's strategic plan, ownership strategic plan, and how they align. And I think one of the places where being in the know about that as the C-suite of what your owner is hoping for can be extremely beneficial in the sales process. Because as Jim said, that separation can occur. And one of the things that, Matt, if you could touch on, is how some of the investments and some of the preparation that you can do ahead of sales end up impacting the quality of the transaction structure and what it means for how long the owner has to stay involved. Because we know, some owners may be more sensitive to saying, you know what, I've done my time, I'm ready to move on to other pursuits, whereas others may say I'm okay being a consultant. So Matt, if you want to touch on that a bit, that'd be great.
Yeah, unfortunately, it's pretty transaction specific. So you've got a really solid team that can run the business without you. It makes life a lot easier. And in the case of Sportech, it's very clear to us and made clear that the owner, wanted to be free and clear of the business going forward, and wanted to sell it outright. So if that strategy is made clear up front, then we can prepare our process accordingly. And then everyone's got a clear understanding, of what needs to be delivered as part of the transaction. But if management, or if the seller is sticking around and rolling into the new deal, the dynamics shift pretty dramatically because they've got skin in the game. There's a lot more reason for a buyer to keep them involved in all the conversations. So, it really just depends on what the objectives of the seller are. But, if you plan to exit completely, those investments up front are absolutely critical, and, could make or break a deal. In the case of Sportech, that team is really, really good. And I'm not just saying that because Jim's on the call, but, they delivered a lot of the value. It's a great business, commercially successful, operationally sound business. But if you're selling to a financial buyer, they need to they need to build that trust, build it very quickly, and understand that the team could help them execute on, the go forward strategy for the business that supports their overall purchase price. So, I guess what can management do? During the process, depending on the dynamics, it's just maintaining that trust with the seller and then delivering themselves and the rest of the team to the buyer.
Thanks for that, Matt. And while we're on structure, but before we move off it, I do want to touch a bit on the reps and warrants question as well as the earnout. So it would be great to see or to hear what is common. And then, just building off of that, a lot of times we hear that owners are most sensitive to what's going to happen with their employees post transaction, and that may limit who they want to sell to. So, if we can kind of combine that into a question that Jim, you pair onto as well, of speaking to how your perspective shifted of selling to PE and how that's been okay for the employees for Sport Tech. But I'll have Matt start just around some of the common reps and warrants and what he's seeing with earnouts.
Yeah. So starting with the reps and warranties, I mean, typically we'll position insurance pretty heavily and, try to negotiate as best as we possibly can that the buyer pay for the premium. But, again, it's case by case, but unless there's some fraud or something bad going on within the business, you can typically get a policy that'll cover your reps and warranties. But at the end of the day, I mean, the buyer just wants to make sure that they've got a fair deal, and the seller wants to make sure that they're not on the hook for anything kind of out of the ordinary. So, we have a lot of conversations up front during pre-marketing and during our marketing, and then when we're getting those initial bids in, we make sure that is a core component, or at least being studied by the buyer. So your second point on earnouts, again, it's very case by case. We try to maximize cash at close in every one of our deals, or at least make sure our clients' objectives are achieved. Generally doesn't include an earnout component, but in certain industries, you just can't get around it. I mean, if there's a huge human capital component, and you've got significant key person risk, you might not be able to get around it in some form or fashion. But in the context of a manufacturing or a distribution business, you might see people push for it, but I would say it's not all that common to see those. If folks really want business, we encourage them to do their due diligence and only consider cash or stock at close. But it certainly happens, and it's more prevalent in certain industries, whereby the assets walk in and out of the door every day, on the business services side of things. But they can happen, and it depends on how good your process is, other dynamics of the business, and who you're ultimately reaching out to or considering selling to. You could have key customer contracts or some, concentration that could affect that. There are a number of considerations that need to be taken into account. But we, quite frankly, just don't see a lot of them with the businesses that we sell or cover. We might see them in offers, but we try to negotiate them out. Around the considerations of selling to a strategic buyer versus a financial buyer, the prep tends to be the same. We encourage, and it depends on the objectives, of course, of the seller and the entity, but we encourage broad auction or strategically targeted auction process if the objective is to maximize value. And a lot of times you might think that you're going to sell to XYZ strategic because you have no idea what the private equity landscape looks like. And there's a lot of money out there chasing deals, especially in the middle market. And so you never know who's going to step up. And so it's important to create a very thoughtful strategic list of buyers and to perform outreach accordingly. Of course, during the process, you can withhold certain information or redact certain information that's competitively sensitive or something like that. In the early stages with strategic buyers, and then disclose later when the situation's been de-risked. So from a prep perspective, it's pretty much the same, regardless of the buyer. And then Jim can talk about it a little bit more. I think there's, a faux insecurity around selling to private equity from an employee retention perspective. And even from a strategic perspective, I mean, at the end of the day, buyers are, buying market share or free cash flow or profitability. They're in the game to make money and return on their investment. And typically you need good people to do that or help effectuate that. And so I think in certain circumstances, there might just be serious synergistic opportunities, and you can try to prepare or protect your employees from that. There are a number of ways to do that, and we again factor that into the negotiations. But at the end of the day, they need high performing talent and human capital to sell those widgets or distribute those widgets and drive profitability. But Jim, this is probably a good time for you to interject on your experience and more specifically with private equity.
Yeah, and certainly it's up to the owner of what he wants to do as far as how the opportunities present themselves, whether it's strategic or private equity. As we had conversations and kind of understood the facets of both buying types, we as a leadership team in partnership with the owner believe that we didn't have any major strategic gaps that we needed to be filled by a partnership or a synergy with a strategic buyer. We thought we were excited about the platform we had and our demonstrated ability to grow, and thought we could actually benefit from bringing other companies into our platform. So as long as it was the right private equity firm that aligned with our culture and our values and had a track record of treating their platforms well, we were more motivated and excited to go partner with the private equity company and the one that we ended up doing. It's been a great relationship. We felt super supported. Obviously, through a challenging year with COVID and a lot of things out there, we were able to, and of course we're a growing organization, keep all of our people intact. And the relationship we have with our private equity owners is more along the lines of how can we empower you to grow versus cost cutting and some of the, I guess, horror stories that you hear about private equity. So that's the path that we headed down. Certainly the owner, it was beneficial to him and it was beneficial to the leadership team. So we're excited where we landed.
Great. Well, so, per the polling question, it appears that most of the ownership teams that you work with, the majority are most focused on their ability to completely exit the business, both financially and operationally, with, lesser concern for, after-tax proceeds or employee retention. Cultural preservation also seems like it's important. So One of the things that I think we'll transition to here in just a second as well is what happens after the sale closes. And I know the conversation today is really focused on preparation, but I think you also have to prepare for the fact that just because the transaction closes, it doesn't mean the heavy lifting that's associated with it and the exit path for the ownership team is complete on that day. So before we move there, Malia, we talked a lot about what the CFO can be helping their ownership team with ahead of the transaction. What are the conversations that we should make sure that people know their ownership team should be having as the transaction structure is negotiated, to make sure that all of the hard planning that they've spent years on has an optimal outcome as those final details of the purchase agreement get negotiated?
Yeah, prior to when the sale closes and the proceeds hit, I think it's important that the owner, along with their other advisors, their attorney, the CPA, and the other executives, really should have a roadmap for what accounts that the proceeds go to, where the funds are going to be distributed to, if there are irrevocable trusts or other structures, personal trusts, charitable trusts, or donor advised funds that are there to receive the funds. That should be factored into the closing process. And if there isn't a pre-plan in place, then I think the best advice I could offer is for the owner not to make any rash decisions, and for the leadership team to be encouraging. Don't rush out, make big dollar purchases, sit on it for a while, and it's not too late to engage in that planning process. I've worked with business owners that seem to already have a plan in their head for what the funds are going to be allocated to. And, they've made, they're used to, after all, they're really used to making, decisions about their business and the funds there, but to ensure that they still maximize the wealth that's derived from the business and passing it down to family. It's really critical that they maybe then start engaging in planning and move that forward with their advisors. So I just a quick question, Jim. The family that you worked with, they did have, I think, a pretty robust plan in place prior to the sale. Am I remembering correctly?
Yep, the owner was very well prepared and had been, preparing it as you recommended for a number of years leading up to it, and had built a relationship with BMO for a number of years leading up to it as well. So that the partnership and guidance between the two, I think that was probably the least of the concerns when he was ready to jump in and make a different decision with the business.
But allowed him probably to focus more on the sale because he knew his personal side of things were already figured out, which I think, one of the things that you touched on is that time is a finite resource during the transaction. So I think as much as you can have figured out ahead of time so that you're not trying to do too many things at once can be extremely beneficial. So Matt, real quickly, we'll quickly touch on post-transaction because I do think it's important, and Jim, jump in here as well. But what are some of the key things that when you look back at successful transactions that you sold, the management team and the buyer had been in tandem with on what they were focused on? I think a lot of times you think just because it's the right buyer, you're going to have a successful outcome with the transaction. But I think there's a lot more to it than just what leads up to the transaction.
Yeah, I'll spend like 20 seconds talking about it, and then Jim can talk about real life. During our process, we try to make sure that everyone's above board on kind of what's going on at the business. They're able to do their due diligence. You're not selling a hockey stick forecast when things are going south, because management's really got to live with that going forward. Jim sits in a pretty unique chair where COVID hit within 6 months post-close. So I'll kick it over to him because it's going to be a lot more interesting than hearing from me.
Yeah, it was a bit of a masterclass in interesting things for the first year. under private equity ownership. I think one of the biggest transitions that we as a leadership team and I as a new CEO had to learn is it's a completely different operating environment, working for a wild-eyed entrepreneur and dealing with and onboarding with all the governance of a private equity firm. So you have a board in place. I report to a board. That was new. We had a board of advisors previously. Now there's a board of directors that represents the investors and shareholders, and just a lot more structure and rigor. And that has turned out to be very beneficial to the way that we run the business. But certainly it was a bit of a culture shock of, if I wanted to buy a new piece of equipment, that used to be a 5-minute conversation. It is not anymore, but the analysis that it drives our team, is a good challenge to us to make sure that we're being good stewards of our business and good stewards of the investors that have faith in us. So that has been different, but it's just part of the relationship, and it has proven to be good structure that supports the business over time. So we appreciate that. And we as leadership look at our job. It's very interesting. Once Chris owned the business for 25 years, and that was a long time. Had a ton of deep relationships with the people in the organization. When you bring in a financial buyer, certainly people are trying to understand how that impacts them at a cultural level. We look at our job as leadership as to be a great buffer, probably isn't the right word, but a good advocate for the culture. And if we're doing our jobs well, the people in the organization shouldn't even feel the fact that we're owned by a private equity company. And the private equity company would agree with that's our job, to keep culture, keep the business going, keep it robust. They just want to come behind us and support us. So that was a refreshing thing, that they had no interest in coming in and changing our culture. They bought us for culture. They bought us for the things that we hold dear to our company, and they've been, super supportive and consistent in that.
Got it. Well, we've got a couple minutes left. So one of the things that I want to close out with is just lessons learned. And Jim, I'll have you kick us off here of things that, you might have changed and done differently to make the transaction smoother or have, some form of a different outcome. But I think, Matt and Malia certainly jump in on things that you've maybe seen that CFOs, CEOs should be guiding their owners so that you do get a better outcome.
Yeah, I think I touched on it before. Some of the dynamics of the due diligence, which were new to the team, we didn't quite know how to make sense of those. So, I would say pretty early on, we clung to the guidance of BMO into navigating us through that. You don't know what you don't know when you get into these processes. You don't know what questions that you should be asking. I think BMO did a pretty good job of helping us figure that out. There was a couple of areas within, the data room and some of the financial, financial rigor and background that we probably could have been a little bit more prepared for. There's a couple of things with regard to customer contracts and things like that are value drivers for the business. I think we probably would have pushed to have a couple more of those in place prior to sale, because those would be assets to the business. The way we had run our business historically, we didn't look at things like that. So probably a good conversation with value drivers with your IB early on would be helpful. And then you just got to kind of feel your way through the cultural stuff and communicate between leadership and ownership.
Matt?
Yeah, I'll spend 2 seconds. The polls resulted in, how do you prep for a full exit? And, I think Chris, who previously owned Sportech, did it masterfully. You set yourself up for success first and foremost, for your family long-term, and then operationally, Chris built a tremendous team. They run a pretty tight ship at Sportech, and that allowed him to, completely exit the business. And then, finally, you've got to understand, or come to peace with what your business is worth. You know, a lot of people might throw a lot of numbers at you. But at the end of the day, you have to, you know, make a decision for yourself. Is this an amount that I'm, you know, willing to walk away with and you know, leave the last 25 years of blood, sweat, and tears for? And I, you know, I've never made that decision, but I imagine it's pretty tough. You know, if you don't have that determined, it becomes very hard to get a deal done. You know, especially at max value, walking away 100% free and clear of anything going forward. So you just got to come to grips with that and, you know, make those tough decisions for yourself and then live with them and stay consistent. If you waffle, it becomes very painful. So Chris did that masterfully, maybe better than anyone else I've seen. And the success of the entity today is a product of that. And I'm sure Chris is happy as well. So I'll leave with those thoughts.
I think the themes of the day, and we're at time, so want to be mindful of the fact that you likely have additional appointments that you have to roll to. But I think that the takeaway around this type of a transition is that having discipline and a process that you go through can really lead to the most successful outcome, whether it is the owner wants a full exit, you're seeking maximum value. I think as much as you can be prepared and starting to figure this stuff out ahead of time, and having the reporting, having the management team that can tell the compelling story, it's going to be that much easier when you go to execute the transaction so that you're not trying to create it in real time. I think it becomes really challenging as a buyer if the seller doesn't have this type of stuff pulled together. And I think it's, you know, just the closing thing is surrounding yourself with a team of advisors. They're there to make you successful. They're not by any stretch of the mind an enemy. They're really there to help you be guided through the process so you get the outcome that you're looking for. So with that, thank you for everyone's participation. To the extent there were any unanswered questions, please do pass those along, but hope everyone has a great rest of your Tuesday morning.
Thank you so very much, Jennifer, Malia, Jim, and Matthew for your contributions to our thought knowledge today for our FEI members. CPE credit will be available in 7 to 10 business days as usual. This ends the webinar, and we do thank you for participating. We wish you the best of the afternoon and have a great day.
Thank you.